Welcome to the Money and Mortgages podcast. I'm your host, Adam Coleman, accredited financial counselor and mortgage planner. Join me as I speak with fellow industry experts on all things personal finance. Welcome, everyone. This is your host, Adam Coleman. Returning to the show, I have David Wanya, a certified financial planner with Financial Synergies Wealth Advisors. And today we're talking all about budgeting, which obviously nobody really likes that word, but we're going to get into reverse budgeting, which maybe that's the opposite of something bad. So maybe people actually enjoy reverse budgeting a little bit more. But we're going to talk a little bit about how that differs from traditional budgeting and maybe how it fits in with somebody's finances a little bit more. So, David, it's always a pleasure bringing you on here. How have you been?
Been good, Adam. No, thanks for having me back on the podcast. I always enjoy your episodes, so it'd be good to be on there twice now.
I appreciate it. Well, jumping right in, I guess, do me a favor. How do you define reverse budgeting and how it differs from traditional budgeting?
Yeah, and maybe I'll start with traditional budgeting, where you think about it as like, hey, we're going to look at everything, every line item, every month, and just kind of go, hey, where's money gone? And I think, like you said at the kind of the beginning of this, is most people find that painstaking, right? They'd rather go get a root canal than versus looking at their budget. So to me, I think it goes back of like, okay, is there a way of, instead of having to go face the fear of, oh no, did I spend too much money somewhere? Is, hey, let's reverse budget a little bit and take the idea of, hey, pay yourself first and then go spend the rest of your money. So we think about it as like, hey, let's save, right? We can put some money into somewhere and go, let's go 401k. We've got a percentage go in there. Could I put money into a Roth IRA or a taxable brokerage account? And all of that comes up to be a savings number. And then from there, you know what? I can spend the rest of these funds.
Right. So, and I guess the main thing would be, what's that number look like? Is there a certain percentage that you have in mind, or does it really vary so much between client to client?
I think it varies a little bit depending on what your goals are. I think hypothetically, you could say that there's one out there of like 20%. Let's say you wanted to retire at 65. I think that's a fair number to kind of that you use, or at least
Yeah.
that's kind of what everybody's kind of talking about in the industry is if you're saving 20% of your income early on, this should help kind of you reach that goal. But again, it's good to talk with a planner, make sure that that's right because situations are going to fluctuate. And so I always think like that's going to be a combination of where you're saving, right? 401k, taxable brokerage, Roth IRA, but that's kind of the percentage. And then it may differ. It may be higher if you're trying to retire early, and it may be lower if you're like, you know what, I'm going to work longer there too.
Right. Well, when you're doing your planning, do you actually factor in if there is a match? Does that get part of the savings percentage, or do you like to have that kind of as a bonus on top of their standard 20% that they're saving?
Personally, I'll view it as more of like an extra piece of it. And I think we can go back to where COVID happened and some of these companies got rid of their company match. So now all of a sudden it's just your savings amount. And some companies have put some things in, some companies that actually have not included a match. So to me, I think about it as let's cover you with your savings. And then if we have any employer ones, then it's just a cherry on top, if we want to call it that.
Where does stuff like stock options or like RSUs and ESPPs, like where does that kind of fit into the mix, or does it in your mind?
I think it matters. It's all income, right? And so I think that piece is like, okay, hey, we've got to think about it not only from a tax standpoint, but also from a saving standpoint. So, and I think this is where you can review your budget if for the reverse budgeting piece is, every 6 months or a year and think about, okay, what has the first 6 months look like? Or what has this entire year look like? Did I reach the savings goal that I wanted to based off of all of the income come in, with that being like the ESPP piece? If I sold those or kept them, depending on what you wanted to do with those shares, the RSU is the same thing, but you're adding all of that money into thinking about like, hey, this is money that I've been, granted this year, and been like, okay, where do I need to go with this? And what pieces do I need to play into the fact of like, hey, this piece needs to be saved here because it's all income this year.
Do you still keep it kind of as a total income number and then build a percentage off of that total? Or does it almost become more of like a dollar figure each year and not necessarily a percentage of income, but do you track it based on dollars, or is it still more percentage based of your total income?
I'll usually keep it as a percentage base as we think about it too, right? Especially in the accumulation stage of your life, you're going to be getting these increases as you kind of progress in your career. Is it if that's yearly or every other year, depending on where you work, your salary is going to keep going up. So if we think about it as just keeping it as a number, slowly that's going to be a less and less percentage where you need to be. So I think keeping it as a percentage is always good to kind of review and look back and being like, hey, my total income is this. Here's what I saved this year, and did I hit that percentage number?
Do you kind of get into more of the automation side? I know that's easy with 401ks, but do you typically set up like automations for into Roth IRA accounts or taxable brokerages, or is it more kind of at the end of the year you start allocating certain things? How do you typically do it with your clients?
Automation is key. If we can
Yeah.
if we can just go, hey, let's set this up and be able to move things around and us not have to do it, but it automatically happens. I think you could use the first, the 15th, or the end of the month as kind of those key dates. But just to think, hey, I get paid, this money is now out. It hits your bank account, but never really feels like it stays there, because I think there's always this one, if it's like, I'm going to do it manually. Okay, it comes in. Now I have to move it. Well, maybe we forget to move it. And then all of a sudden there's an expense that comes up, right? Or it's like, oh,
Right.
I have this money to go spend. So my thought is, if we can just go, hey, the 401k is going to kind of take care of itself from your paycheck. Even if you can't contribute to a Roth IRA or a Roth IRA directly, then it's one that we go, hey, let's just go to the taxable brokerage account and then kind of figure out what we need to do for that piece at the end of the year. Or is it, even from the bonus time, can we do a backdoor Roth or something to that aspect to be able to kind of help make that process as automatic as possible? But I'm a big proponent is like automation is key.
Yeah, for sure. And I think it just makes it easier so that you don't, it's not top of mind. Like it's just kind of out of the picture. It's already put into the account. So you don't even feel like you have it at this point. I think manually making that transfer can sometimes be painful for a lot of people. So if you don't have to worry about that, afterwards, and you're really just not budgeting for it at that stage, I think that's a huge benefit for people. Do you track things through? I know you have financial planning software that you do it through, but for the consumer level or the client level, how do you typically like for them to make sure that they're staying on track of their savings goals, but also, kind of from that reverse budgeting standpoint, making sure that they're not going over certain categories too badly after that savings goal is hit? Are there specific apps or methods that you like better for tracking those things?
I think it depends on the person and kind of what they like to use. I think the two that you hear the most is kind of Monarch Money, and not sponsored by either one of them. So Monarch Money
Right.
or YNAB, right? And I think it depends
Yeah.
on what you're looking at, right? Where I think if you want more of a budgeting piece, YNAB probably really digs down into the weeds and you can really get into it. But again, I think for the reverse budgeting piece, it's like, do you want to do that? Maybe you do it from a high level on YNAB. I think that's kind of why there's some people that like Monarch more, because they'll show a net worth piece and then kind of the categories from that side. And again, you can keep it really high level if it's just one that I'm like, hey, you know what? I know I'm saving this money. Just kind of see where my expenses are adding up to.
Have you used YNAB much, or do you tend to use Monarch for a lot of this stuff?
I used to use YNAB early on in my own professional career, and then I kind of switched to using Monarch now.
I've never really dealt with YNAB all that often. I know enough about it to kind of see where it fits in. Does it do a pretty good job of allowing you to do the reverse budgeting piece where you've already kind of allocated a certain percentage to savings, or is it more the traditional budgeting piece from what you've seen?
More traditional budgeting piece.
Okay. Yeah, and Monarch's not quite as, I guess, picky when it comes, or it's so much more work on the YNAB from what I hear. Like you have to really set it up ahead of time. But like for certain people, that's a huge benefit. But then others, they're kind of like, I think me and you, where we do pretty good maybe tracking expenses after the fact, but not necessarily putting it into pretty little buckets that YNAB seems to have. I think Monarch kind of fits in between there from what I've seen, where I've looked at that a little bit more than YNAB for sure. But yeah, I was curious to see what you've used. I know YNAB gets great reviews and people say, wonderful things about it, but it seemed a lot of effort for the person that might not necessarily like budgeting to begin with. I don't know if it's a lot to deal with for those people, but any other apps that you've come across that you like besides those two, or are those pretty much the big ones that I've seen as well?
Those are the two big ones that I've seen the most. There's a couple other ones, but I have not been able to kind of dig into them as much.
Yeah, like I've used Empower before, and it kind of has a pretty good idea. It's not very good for budgeting from what I've seen, but it's decent for tracking, like retroactively seeing where your money went. But it's probably not very good at figuring out where the money needs to go. But where do things fit in? Because obviously we're talking, a great idea of saving 20%, but there's other things that have to happen before that. So what does that order look like for you? Because obviously there's high interest rate debt consumer debt, credit cards, things like that. Presumably we're talking about paying those off first before we even talk about a big savings percentage. So what do they need to do before they start focusing on that 20% savings rate to do the reverse budgeting for?
Yeah, no, I think you're right. I think it's trying to get rid of the consumer debt as much as possible, if not all of it, right? I think we all know where credit card interest rates are. So I think it's one that if it makes a lot of sense to just kind of wipe that out as much as possible and then go, okay, now I don't have any more debt. Now I can go to the other piece of the investing one. But it is one that I think the debt piece is it's kind of a big topic, and consumer debt is one of those ones where you want to kind of eliminate that as much as possible before getting into the savings piece.
I mean, you can at least you get if you have a 401k with a company match, you can start there in a lot of cases. So that starts the process for the 20%, but you're not going to get the full 20% before the debt's paid off. How does that look differently in your budgeting world? If you're more a traditional budget versus reverse budget, does it change when it comes to paying down credit cards with that budgeting method, or is it still kind of the same process? And then really reverse budgeting fits in once you have some savings on top of that to really play around with? Or is there a way to do reverse budgeting with consumer debt?
I think you could kind of do the reverse budgeting with the consumer debt, right? And think about it just being like, hey, I'm paying myself, but this piece is going to pay off the consumer debt portion of it.
Right.
It may
Okay.
not be that I'm quote unquote investing or saving this money, but right now I'm going, okay, this is where this money is going. And then once that's paid off, I can still make the same payment, but now I'm either doing it to a 401k, a brokerage account, a Roth IRA, an IRA. Now it's being invested.
Gotcha. So basically, instead of a 20% savings rate, you're still trying to save, theoretically save some sort of percentage, but then you're just allocating it towards more aggressive pay downs for the debt as opposed to throwing it towards investments. Is that the idea?
That's the idea. Is we're gonna tackle the debt that way and then kind of go, okay, this is kind of priority number one. This is the payment we're making. Here's where this goes. And now all of a sudden, hey, we've paid this off. We're down to zero. Now we can kind of invest.
Right. Okay. How often do you usually like to update people's numbers when you're going through reverse budgeting? Do you treat it monthly or even more quickly or more sporadically?
I think it's more of one that we know what kind of income looks like at the beginning of the year, and then we'll just kind of review it at the end of the year and know kind of, hey, these are the numbers we've hit. Kind of review that, know that hey, there may have been something that happened in between the year that we didn't hit the number or we did hit the number, and just kind of reflecting back on, hey, I feel like I've either spent too much, and then we just kind of remind, hey, here's the savings piece, and then I think it's one that you almost kind of forget about it because you don't see that money, so you kind of forget
Right.
that you've actually put this money somewhere too.
Where does big ticket items fall into place for this? So, like, do you still try to keep that same percentage, or do you find that if somebody's got like a home purchase or a car loan or a big vacation or something like that, are they adjusting that savings percentage, or are you trying to reverse budget into a different category of some sort of like sinking fund or down payment fund, something like that? What does that look like on a day to day for you?
Yeah, I think if we can keep that 20% savings number or the percentage that they're trying to save the same, great. And then can we kind of slide in another payment somewhere and not necessarily add it to like the investment piece, but just go, if it's a car, let's say we need to make a 500 or $1,000 payment on a car, can we kind of allocate that somewhere and keep that and just kind of see how a couple months go and making that payment while still investing and keeping your budget the same, or I guess it's going to change a little bit because there's not going to be as much free cash flow for discretionary spending because you're kind of saving for that big ticket item.
Gotcha. Okay. I guess, any big mishaps that you've ever seen people really get into or mistakes that people make with reverse budgeting or traditional budgeting that you run into where they kind of need to stay top of mind to avoid some of those mishaps?
I think the probably the biggest thing with like the reverse spending is like it's like, oh hey, I'm only going to live once, so let's go have a bunch of fun, even while I'm still saving. But I think we also have to remember that it's like I can't go spend every dollar that's there. I've got to think about it like for tax planning purposes and other things, depending on what your situation looks like. You brought up equity compensation. I mean, there still could be a tax bill that we have to plan for. So it's not that, hey, I've saved this amount of money, so every single dollar that comes in can go out. It's just kind of trying to balance the two. And I think that's where I think reverse budgeting from my side as the planner is to think, okay, we're saving, this is great, but what other items could pop up that could be the I gotchas that we don't want to have happen?
Gotcha. How often do you see people come in, like clients of yours, actually one do any budgeting? Is that pretty standard? Are they mostly doing something, whether it's reverse budgeting or traditional budgeting, or are they starting completely from fresh?
I think you've seen it on both sides of the spectrum. I think you have ones that are kind of very deep into the budgeting, then you have ones that have not budgeted at all. And so it's kind of, trying to see the spectrum. And you don't ever want to say like, hey, you should go into reverse budgeting, but it's like one, if it's, hey, if it works and you're diligent and you can go, hey, this is the way to save, awesome, let's do this. And then just kind of think about the rest of your income as just discretionary. And then there's sometimes that people just need to sit down and go, hey, I need to know where each dollar goes. And that's just going to be kind of one of those ones where it's going to be line item by line item. And I'm probably looking at a little bit more than maybe the normal person would.
Right. Well, and I guess once you get the savings done, like the 20% off the top, does it still look in your mind very similar to traditional budgeting where you're still tracking where the money goes, or are you taking more of a flexible approach at that point where it doesn't really matter as much where they actually spend their money as long as they haven't gone over for that month? Or do you still allocate certain dollar figures to groceries or to car payments or things like that?
Yeah, to me, I think it's more of the second approach to it of just kind of like, hey, you're thinking about this as like we're saving. Hey, did you stay within the minus amount that you're like having per month, right? Of going, okay, hey, we saved, let's just say $10,000 per month. Hey, 2,000 of that is gone for savings. The rest of this is kind of being spent as long as we can spend it, depending on what your situation looks like. And understanding it, hey, it may be some of that's used for travel. Some, again, kind of some of it's used for taxes. Some of it may be used for a car payment. I don't think it's necessarily getting down to the nitty gritty of like, oh, hey, I spent too much on groceries this month.
Right.
But it's, I think it's looking at it as going, hey, we know that we've saved. The excess is there to kind of spend a little bit.
Do you see people adjusting that savings percentage, throughout the year quite a bit, or do they usually kind of stick to the same number and then just try to hit that? Do they kind of live within that means, or do you see people being way off track once they get started with the reverse budgeting?
No, I think people stay really on track with it. Again, I think it goes back to the automation key, right? I think it
Yeah.
is, if we can just do that, then it just kind of naturally happens. I think the other piece is if all of a sudden that falls off, I think that's where you start to see, hey, things break down a little bit more because again, there's just this influx of money and where's it supposed to go? And if it falls back on a client to do it, sometimes, hey, that ball may not, or that money may not get moved over where it needs to. And then all of a sudden, hey, like I was gonna say, the ball get drops a little bit. And then it's just like, oh, hey, 3 or 4 months go by and you felt like there was a large influx of cash, but now all of a sudden there was this thing to spend this on, and instead of going back to the savings number that way.
Gotcha. Where does maybe somebody that has like more of a variable income, how do you treat that any differently with reverse budgeting as you would with really traditional budgeting or not budgeting at all? Does that change things in your world when they don't have a set amount that they're getting every single month?
Yes, it does. And it's something that we've just got to kind of think about of, somebody in sales or a commission based business where you're thinking about it. Okay, hey, we may have a really large 1 month or first part of the year, and then it may be a little slower. And we just kind of have to think through how much needs to be saved, where that needs to be allocated, and what does that look like? Because it is very different than thinking like I have a paycheck in twice a month and here's what's going to be taking out versus, hey, I did really well. Here's what my commission check's going to look like. We got to think about some of that's got to get you through the year. And then also being like, how much can we take for that savings number?
Does that, I guess from an automation standpoint, that's still figured out because they're still pulling money out of their 401k, assuming that there is a company 401k with what they have. But do you build in any other accounts for, a sinking fund for home repairs or taxes that are coming up? Like, what does that change from a bucketing strategy of where their money's going in an automated way to account for future variations? Or is it not that granular?
No, I think it's kind of that granular, and it may be to the part of thinking about, okay, we've talked at the beginning of the year of kind of what we think things are going to look like. We don't know what may happen as you're in your sales job or that variable income position, where hey, there may be a spike in income later on, but we kind of have a general overview of maybe what spending does look like, and then think, okay, hey, this is kind of what your income was last year, so we're going to build in a savings number about that. what other major items may we have throughout the year, and just think, okay, here's kind of a paycheck, or here's a commission check you got. How do we use this, and where does this go? And then, like you said, I think it is one that goes back to being like, in my mind, with the reverse budgeting piece, it's always going to be that save and invest number. It's high priority because we want to hit that, but then also think about, like, are there any home improvements? Is there a car purchase or a big ticket item that's going to need to be paid for this year?
Nice. Okay. Well, that was super helpful. I guess anything else you wanted to run through on the reverse budgeting piece versus traditional budgeting?
No, hopefully it makes it a little bit easier to to look at and review that way. Like I said, I think it's one where we've seen it work, and it's just kind of a nice one on that piece, just to think, hey, let's save and invest first, and then think about the rest of the income later, and kind of, hey, just have a little bit more freedom being able to spend it versus being like, oh, hey, should I go stop and at maybe one of our favorite coffee shops to get another coffee, and not have to look at your budgeting app to be like, oh, I can't do it this month.
Right. And then figure out what savings you have left over,
Yeah.
and then pray that it's enough to
Yeah.
actually do anything useful, or that you even went to the negative, unfortunately. So no, I agree. I think this is a more common sense approach to it. I think it's more sustainable. I think I would never be very good at the traditional budgeting, but I definitely like the automations behind reverse budgeting. I think it works better. So no, this has been great. I appreciate you taking the time and explaining everything.
No, out of
If
it,
anybody wants to know more about you, what's the best place to track you down?
LinkedIn, Twitter, that's where I'm at. So feel free to kind of look me up, plug me that way. And then I don't know, it's been great talking with you as always.
I appreciate it. It was good talking with you.
All right.
All right.
Bye.
Thanks, David.